Welcome back to another explainer. Today, we're taking a purely clinical look at one of the most fascinating and, frankly, volatile market phenomena out there, the boom and bust cycle. We're going to be using a very specific, recent case study, the Trump meme coin, to examine the intense mechanics of market volatility, hype, and speculation. My goal today is to help you cut through the noise and understand exactly how these financial cycles operate right under the surface. All right, let's dive right in. Here is our roadmap for today. First, what is the Trump meme coin? Second, we'll track the massive hype rally. Third, we'll break down the 97% crash. And fourth, we'll wrap up with some crucial lessons for every investor. Okay, Chapter 1. What exactly is the Trump meme coin? Before we get into the wild price swings, we kind of need to nail down what a meme coin actually is. Basically, it's a cryptocurrency driven by internet culture, community enthusiasm, and pure speculation rather than any practical utility. It's literally a financial asset powered by internet jokes. And it's incredibly important here to separate the asset itself from the political figure it was inspired by. The Trump meme coin was created as an homage to the former US president, for sure, but it trades entirely on community hype. It isn't backed by any underlying technological use case, and there's absolutely no official political endorsement. And this brilliantly illustrates a massive divide in the cryptocurrency world. On one side, you have utility cryptos, things like Bitcoin or Ethereum, which are actually built to serve specific technological or financial functions on the blockchain. But contrast that with sentiment crypto, which encompasses meme coins driven almost entirely by hype. When the Trump meme coin launched, people weren't buying in for its revolutionary tech. They rushed in hoping its cultural popularity would just keep pushing prices higher and higher. So, what poured gasoline on this fire? Social media. Influencers, day traders, and online communities were discussing the token non-stop across every major platform. It created an absolute digital echo chamber of excitement. As this demand skyrocketed, the price climbed right alongside it, rewarding the earliest investors with massive paper gains and setting the stage for what came next. Which brings us to Chapter 2, the massive hype rally and the sheer power of FOMO. Our source material points out something wild. Stories of people doubling or tripling their investments spread across social media. I mean, imagine scrolling through your feed and seeing everyday people claiming they just struck gold overnight. That kind of virality acts like an accelerant. It encourages even more aggressive buying, creating a market environment completely untethered from reality and driven purely by infectious hype. Let's break down how this actually builds, because it's a classic speculative loop. Step 1. More buyers jump into the market, effectively pushing prices up. Step 2. Those rising prices act like a giant neon sign, attracting even more buyers who desperately don't want to miss the boat. And Step 3. Excitement just hits this absolute fever pitch. It's a self-feeding loop of compounding momentum, where logic totally takes a backseat to enthusiasm. But here is the million-dollar question we have to ask ourselves. What happens when the buying pressure finally slows down? Because history proves time and time again that markets running primarily on hype simply cannot maintain their peak valuations once the inflow of new money dries up. The momentum has to end eventually. And that leads us to Part 3, the 97% crash and reality setting in. Here's the exact anatomy of how a peak quickly turns into a mass exit. First, the momentum just kind of fades. There aren't enough new buyers left to sustain the rally. Second, early investors, the ones sitting on those massive paper gains, start cashing out to actually take their profits. Third, overall trading activity slows down as the hype wanes. And finally, Step 4, as selling overtakes buying, prices fall sharply. The exit door gets very crowded, very fast, and the panic sets in. The end result? A staggering 97% drop. According to market reports, the Trump meme coin lost roughly 97% of its value from its all-time high. For investors who bought in near the peak, completely swept up in the social media frenzy, the financial losses were absolute. So the crucial takeaway here is this. Boom and bust cycles are brutal, but they are incredibly common in the crypto space. Rapid gains can, and very often are, followed by equally rapid declines. This isn't unique to this one specific project either. It is the textbook life cycle for sentiment-driven meme coins that lack the long-term fundamentals required to anchor their value when things get turbulent. All right, Chapter 4. Lessons for every investor. We've got 4 really vital takeaways here. 1. Never invest based solely on hype or trending social media posts. 2. Understand that meme coins are arguably the most volatile assets in the entire market. 3. Never ever invest money you cannot afford to lose. And 4. Diversification matters. Putting all of your hard-earned cash into one highly speculative investment exponentially increases your financial risk. What's really fascinating to me is the sheer contrast between a logical, long-term strategy and emotional trend chasing. Successful investing isn't about getting lucky on a meme. It's about managing risk, staying informed, and thinking long-term. Risky behavior, on the other hand, that's jumping from token to token, chasing every trend, and basically just hoping you aren't the one left holding the bag when the music stops. Our source material sums this up perfectly. In crypto, excitement alone is never a guarantee of lasting value. The rise and fall of the Trump meme coin really showcases the extreme unpredictability of the cryptocurrency market. And whether this specific token eventually recovers its value or not, that fundamental truth remains. Excitement is fleeting, right? Lasting value requires genuine utility. So, I'm going to leave you with this final, provocative thought to consider for your own portfolio. Are you managing risk, or are you just chasing the next wave of hype? Knowing the difference is the absolute first step to true financial literacy. Thank you so much for joining me for this explainer. Keep learning, stay focused, and I'll catch you next time.